Hims & Hers has fallen roughly 40% from its mid-2025 highs, sliding from over $66 into the high 30s. The reason isn't a collapse in fundamentals, but a sudden wave of fear surrounding GLP-1 regulation. In my view, the market is confusing uncertainty with permanent damage, and that disconnect is creating a compelling opportunity. Despite the sell-off, the core business remains strong. Hims is still growing revenue at 50% plus, with an annualized run rate of about $2.4 billion. Subscriber growth remains robust, margins are best in class, and the platform continues to scale. Yet sentiment has flipped almost entirely negative. The panic stems primarily from the Novo Nordisk and semaglutide conflict. In April 2025, the FDA declared the semaglutide shortage resolved, restricting traditional compounding. Shortly after, Novo reportedly issued cease and desist letters, reigniting fears that Hims' weight loss strategy would be shut down. Bears argue Hims is merely a middleman offering gray market Wegovy substitutes. That narrative ignores reality. Hims operates in a regulatory gray zone, but one that is currently tolerated, personalized dosing based on clinical need. This distinction matters. More importantly, GLP-1s are not the business. They are only one growth vector. Short-term turbulence did show up in Q2. Revenue dipped sequentially, and operating and free cash flow briefly turned negative, but Q3 already showed a rebound, reinforcing that Hims is not a one-product story, but a diversified, resilient telehealth platform. What the market continues to underestimate is the moat Hims is building. First, personalized medicine is becoming the core product. Non-personalized subscribers stagnated in Q3, while personalized subscribers grew nearly 60% year over year. These customized solutions create higher switching costs and stronger retention, turning Hims into a healthcare ecosystem rather than a transaction platform. Second, vertical integration gives Hims a structural advantage. With in-house fulfillment and a 503B compounding facility, Hims controls supply, launches products faster than competitors, and protects margins. Even with GLP-1 mixed pressure, Q3 gross margins remained an exceptional 74%. Third, diversification reduces regulatory risk. Mental health and dermatology continue to grow at double digits. The Hers menopausal platform targets an underserved market using the same personalization flywheel. International expansion via Zava, UK, Germany, France, and Livewell, Canada, extends the runway while reducing dependence on US FDA dynamics. Valuation highlights the disconnect. For 2025, assuming the midpoint of guidance implies $2.35 billion revenue and $312 million adjusted EBITDA. Management targets $6.5 billion revenue and $1.3 billion EBITDA by 2030, a 20% margin. Using conservative assumptions, 100% cash conversion, 10% WACC, and 3.5% terminal growth. Hims only needs 10% annual growth for 7 years to justify today's valuation. That's extremely low for a company that historically grew 60 to 70% annually. Using management's own 2030 guidance implies a 22.6% CAGR, which aligns with independent telehealth market estimates. Under those assumptions, fair value approaches $17 billion, suggesting upside of roughly 100% plus from current levels. Risks remain. A stricter FDA stance could hurt GLP-1 revenue. Weight loss churn is real. Margins may compress as mix shifts, but none of these justify pricing the company as if growth is about to stop entirely. In short, the market's reaction looks emotional, not analytical. Hims & Hers is navigating regulatory noise, not a broken business, with modest growth required to justify today's price, and realistic growth pointing far higher. I view the current sell-off as irrational. I rate Hims & Hers a strong buy at these levels and have personally increased my position.